Y'all hear that beat? Hey, hey, come on now. Body dope as me, I dress so fresh, so clean. So sexy, I dress so fresh, so clean. Come on, I'm about to get up. I dress so fresh, so clean. Come on, let me throw a braid on that. I dress so fresh, so clean. And y'all know, I don't know no other words after that. I don't know no other words after that. I just want to get up and just, you know how they be doing a little leg and a little hip? You like 1 and 2 and 3 and 4. I'm not even on beat. Hey, y'all. Happy Wednesday to you. I missed you. It's been a whole week since we last convened together. So I want to thank all of you all for pulling up on time tonight. Like I said, we are going to have a conversation today. You see, I'm already, let me just get the Black Entrepreneurs Workbook. You know, that's a little name drop right there. Fan myself off a little bit. Today, I'm going to recommend 2 exchange-traded funds that I want you to look at. These are investments for people who might be new investors, who are looking for the type of funds that have the potential to return 3 times, 4 times, 5 times the initial investments. We're going to have a transparent conversation about what mutual funds you should select in order to get your retirement portfolio started while you're young. And finally, we're going to tiptoe over into LLC land, and we're going to have a frank discussion on how you can start a cheap business and yield maximum cash flow. So let's get started. So before we jump into what investments you can make with your stimulus check, I always like to tell people who are seeking to invest, especially for the first time or beginning investors, is to ask yourself, right? If investing is too expensive for you at this time. I know that investing is trending all across the internet as people talk about, I'm going to be the next investor in my family, right? I'm going to be the Black Warren Buffett, right? Whatever you tell yourself, everyone's trying to figure out how you can get in on the stock market. But before we talk about the stock market, one of the conversations that I want you to have with yourself is an honest conversation about your finances. There are people watching this live right now where your debt is looking over your shoulder, tapping you, talking about, I thought Stimmy was for me. Who is Stimmy? Stimmy is your stimulus check. Okay? When you have debt, that is money that is working against you. Because it's money that you use that did not belong to you that somebody is charging you interest on. That's what interest is. That's people paying you to borrow that money. And as long as you hold that money, the more expensive it gets. So if you're watching this live and you have revolving debt, what is revolving debt? Revolving debt is that debt that you can pay back but still have a credit line, still have a credit limit. So you may have a credit card that has a $5,000 credit limit, right? You spend all the way up to $4,999, and by God's grace, one day you get it back down to zero, you still can spend up to $5,000. I wouldn't advise it. But that's revolving debt. That is money that you can tap into whenever you need it. If you have revolving debt that is in the 4 and 5 figures and your interest rate is in the double digits, so you're looking at 19% APR, you're looking at 20% APR, you're looking at 22% APR, then you need to take that stimulus check if you don't need it for lights, for water, for food, for a roof on your head, and you need to put it down on that debt. Because let me tell you who doesn't want you to pay it off. The creditor. Oh, now they don't want you to hold your money. You know, people be looking at creditors like, they don't like me. They don't want to give me money. Yes, they do. Because the more money they give you, the more money they earn on interest. So if you have 4 and 5 digit credit card debt and you have 2-digit interest rates, you need to use this stimulus check to pay down your what? Your debt. Let me tell you something. If you have a $1,000 credit card balance, with a 22% interest rate, a 22% APR, and you're paying the minimum, so you're paying $25 a month, it will take you 73 months and cost you $819 in interest before you pay it off. Now, if I told you I would lend you $1,000 and all you had to do was pay me $25 back but never mentioned interest, just told you a number like 22%, what I'm really saying is you can hold $1,000 but give me back $819. Oh, I want you to hold it for 73 months. Why do I want you to hold it for 73 months? Because I'm getting paid off your ignorance. You so people who teach you about investing but first don't teach you about eradicating your debt are setting you up for failure. Let me tell you something. Look, y'all already got me in here glistening and sweating. And for some of y'all who's like, I don't pay the minimum. So Professor Keys, you're not talking to me. I don't pay the minimum. They asked for 25, I gave them 50. Unless you're giving them the full 1,000 to pay it off, you're paying interest. For those of you all who pay $50 a month, let's say it's still $1,000 balance, you still gonna pay them $115 in interest. And for those of you who said it's only $115, it's $115 you could have kept in your pocket. So if you have a high balance on revolving debt, it is too expensive for you to invest in a substantial way. Second, let's have an honest conversation about saving. Now, y'all know I pulled up on Instagram. You know, I was feeling myself in my little Amazon pants. I ain't got no butt. But, you know, the Amazon little leggings, you know, they make it feel like it sit up a little bit, right? So I'm showing off in the park, taking the walk out. I already did my 4 or 5 miles of running. But I'm like, I'm just going to take a walk around this park. My future husband might be in here. I don't want you to see me from the front. I want you to see the Amazon pants from the back. But we're not talking, this is not about the pants. This is not about the pants. This is about the caption. Because I said, you know, I got to say something smart, even though it's all, I want people to see the leggings, but I got to say something smart. And one of the things that I said was I talked about my journey to getting to a 6-figure returning lifestyle. Notice I didn't say 6-figure salary. I said 6-figure returning. And how I got there was living an unsexy life. You know, you see people flexing all over the gram. They got stacks of money. Hello. The stack of money don't even got a phone plan on it. Hello. They got 2 stacks, $1,000 up to their ear. $1,000 ain't even the bank earning interest. Talk about hello. You know, they over here flexing. 6-figure cars. You jealous. They pushing 2 Tesla Jeeps. You don't know what's in their bank account. How I got to a 6-figure returning lifestyle is by living an unsexy life. You know, that's the type of life where I started off with a roommate. I was a roommate in a 1-bedroom apartment sleeping on the couch. Unsexy. Boyfriend talking about, can he come over? I'm talking about, where you gonna sit on the floor? The couch is my bed. I don't want your butt on my bed. Right? So the unsexy life. My friends out here balling. You know, they in Neiman Marcus. They in Macy's. For me, Macy's was balling. I'm over there in the Salvation Army on the on-sale rack. That's the unsexy life of saving. I'm over here on the on-sale rack of Salvation Army where the average cost for a shirt is $3. I'm trying to get one for 75 cents. The unsexy life of saving. Does your favorite influencer pull up on the gram trying to flex the fact that she did her own braids? Because that's what I've been doing for the past year. My edges, they're not clean, they crunchy. Y'all see these crunchy edges? I got them, but they crunchy. Why? Because I'm not a braider. But this is what I know. I can do this. I can do this right here for $100, but if I go sit in someone's chair, it's $400. In order to get to the type of lifestyle that you want to live, the cost is not going to be the flex. The cost is going to be the sacrifice. What are you willing to sacrifice in order to level up to get to a 6-figure returning lifestyle? People might not like it, right? People might not like it, but I bet you the profitability that comes on the other side of the unsexy saving lifestyle will. And you got to make that decision. Why am I spending so much time on saving? Because we can get to investing. And I'm going to break down the types of exchange traded funds, the type of mutual funds that you should have in your holding if you're ready to get there. But very little people talk about preparation before they talk about profitability. I paid down my debt before I made my first investment. I paid off my debt before I started making significant contributions to my investment portfolio. I've been shopping in Salvation Army for years. So I'm not talking about the cute folks who be like, I need to go find me something bitches in Salvation Army for this dance. No, I'm talking about Salvation Army knows your name. I'm talking about you've been taking lunch. I'm talking about why DoorDash is getting you with these $5 coupons but charging you a $17 delivery fee. You still up in the kitchen cooking. I'm talking about that lifestyle that get you to the point where you can invest in your retirement in such a way where you don't have to worry about interest taking every daggone dollar that you earn. Preparation before profitability. Now, I know y'all got up on this live. Y'all like, hey, girl, I just want to talk about the stocks, and that's the problem. People investing in portfolios that they can't afford, and then when they lose money, they get so disengaged that they never try again. We're talking about preparation, right? The cost of success is sacrifice. What are you willing to sacrifice so your descendants can say thank you? Thank you for becoming financially literate so that I can take my inheritance, right? I can take my inheritance and ensure that every descendant after me has the head start that you only dreamed about. Whew, I'm a church fan that. See, y'all got me. Y'all got me all up in here. We're supposed to be up in here talking about stocks. We up in here talking about savings. This is the right thing to talk about, but your girl is glowing. Now, let's keep going. General investing tips. Let's get to it. Right? Let's get to the icing of it. So you done paid down your debt. You got $1,000 up in your savings account looking all good, right? You living that unsexy but highly sexy for the right wealth-minded individual, right? For a wealth-minded individual, anybody who saves is incredibly sexy, right? Forget a big butt and a smile. How that savings look, boo? Hello. So you've done all of that. What are those general investing tips for new investors? So one of the most popular questions that I get in my comments is, what's the best application and what's the best website to use when I'm looking to invest for the first time? And one of the things that I recommend is that you consider opening at least 3 brokerage accounts. Why do I say 3? Because those of you all who were watching the internet, right, and watching the news in March, and watched when the entire stock market went on sale, which means that the average stock price dropped significantly, right, went to log into some applications and they were unavailable because the interest was so high. The reason why you choose multiple brokerage accounts is so that you always have access. And also you choose multiple brokerage accounts being the financial accounts that you can access in order to buy or sell stocks, is because different brokerage accounts offer different benefits. There are brokerage accounts that allow you to buy on the OTC markets. Those are the over-the-counter markets. So you can buy marijuana stocks. You can buy cryptocurrency over there. These are highly volatile investments that not every brokerage account allows you to access. But perhaps you've done your research and those are the brokerage accounts, right, where you want to make sure that you potentially open. There are brokerage accounts that are educational based. So when you open an account on those brokerage accounts, they teach you about investments just by the information that they lift up. This is the 52-week range, right? This is what analysts say. You should buy it, you should sell it, right? They may have on there, right, how much your stock price was worth when you purchased it versus how much it's appreciated in value. They may have the trading value. So some people like, because they're new investors, to sign up with a brokerage account that allows them to learn. And finally, there are brokerage accounts that allow you to give the gift of assets. Say that 5 times fast. You know, you over here, you shopping for a birthday card, you shopping for the newest Jordans, right? Kanye West may not be a billionaire, but you still supporting him because he a black man, so you looking for the latest Yeezy boots, right? Yeezy whatevers, right? So you trying to buy those. I don't knock you, but could you also give the shoes and give an asset behind the shoes? You buying Jordans, but are you buying Nike stock? There's some brokerage accounts that allow you to give the gift of stocks to your family and your friends. Now, the stocks that I have, or the brokerage accounts that I have, include Robinhood, E-Trade, and also Fidelity. I also have an account with Stockpile, so I have 4 brokerage accounts. And I use each of these brokerage accounts in order to make different investments in different places and also different spaces, okay? So, the other thing that you want to do is when you're starting out as an investor, you want to make sure that you budget for investing like a bill. All right? So that's one of the things that you want to think about. You want to budget for investing like a bill. And what that means is that sometimes people will get a huge lump sum of money, and what they'll do is they'll say, oh, great, now I can become an investor. No, an investor is someone who realizes that you can never time the market. And so just like you pay your phone bill every single month for $30 and $40, $100, $125, I don't know your business. You might be Cricket, you might be Verizon. That's on you, right? So, but you budget out to make sure you pay that bill, right? So people don't call you and they be like, hello, so-and-so don't live here no more. You know, however the operator sound, right? This line is no longer connected, right? So you budget to pay your bills, budget to invest, because that allows you to take advantage of the market highs and the market lows. Fancy terminology like dollar cost averaging is what that's called. And then finally, let's get into it. Your first investment as a new investor should be an exchange traded funds. All right, exchange traded funds, because what that allows you to do is make one purchase and invest in many different companies at the same time. Keys, what do you mean? Imagine if I had a mall, right? A mall. I know I'm from the South, so that's M-A-L-L. I own the mall. And I said, you can buy a percentage of ownership in this mall and then own a piece of all of the stores inside. Okay, so that means maybe in my mall, right, I got the Nike store, I got Macy's, right, I got Pandora, I got Spotify, I got McDonald's. If you like to eat healthy, perhaps I got Chipotle or Chipotle, as some of you all call it. It allows for you not to have the stress of picking one company that can have the highest amount of returns. All right, so you always, as a new investor, want to look for those exchange traded funds that allow you to invest in many different companies at one time. Now, tonight, I'm going to talk to you about two potentially high performing ETFs. But before I do, one of the first ETFs that I recommend for new investors that are safer than others, and notice my language, I said safer than others, because when you say safer than others, what I'm saying is no investment is ever 100% safe, okay? You could lose all your money. Your money can increase 10 times in value, and that's the calculated risk you take when you research. Okay, so it's safer, but it's not entirely safe. And that's why we talked about paying off your debt and making sure that you have savings first, because if you lose it all, right, if you lose all of your investments, you don't want to lose your house behind it. You don't want to lose your mind behind it, right? We want to make calculated investments. And so one of the safer investments that you can make is in the SPY, and that is the S&P 500 Spider ETF Trust. And when I want to start with the safer investment before we talk about more innovative investments. And what the Spider ETF Trust does is allows for you to invest in the top 500 publicly traded companies like Facebook, Google, Amazon is in there, Chipotle, ExxonMobil, Boeing, like all of the top companies that have brand recognition are in there. So that is the SPY or the VOO, which is the Vanguard S&P 500 ETF Trust. Okay, so somebody write that down, put that in the notes, VOO and SPY. These are the stock tickers. So if you have your Robinhood app, you would type in SPY and that will pull up, and you could type in VOO and that will pull up. Okay, so let's talk about the first investment. Now, if you're in this live, right, I don't want you doing this when I ask this question. How many of you all up in here bought a share of GameStop? Come on, let me see it. Go get up in the comments, because you see when I do this, I'm reading the comments. How many of you all bought GameStop, right? How many of you all have purchased an investment simply because it was trading on the internet, right? You don't know nothing about the company, but simply because it came across your timeline 5 or 6 times from 5 or 6 people that you don't know, you thought it was a great idea. Maybe let me ask you a safer question. When Apple split, when Tesla split, did you buy those companies because you researched them, or did you buy those companies because it was popular? Ask yourself that question, right? So some folks are like, I don't know, Keys, you getting all up in my business. You're supposed to be teaching me. You're not supposed to be in my business. I'm in your business. So one of the first ETFs that I want to talk about today is Buzz, all right? B-U-Z-Z, Buzz. Buzz is one of the newest exchange traded funds on the block. And the reason why I want to talk about a new fund versus an old fund is because these are the types of funds where people look back on it years ago, right? Apple was $5, or excuse me, when Amazon was $5 and still a bookstore, right? Somebody bought 100 shares and now they're 100 millionaire, right? And they flexing on the gram, talk about way back when in the 1990s when Amazon was selling books, I was buying it for 50 cents. Where was you at? Right? So I like to talk about new funds because it's an opportunity to get in on funds, right, that may have a good investment methodology, and we'll talk about that could potentially make you higher returns on the other side. So The thing about Buzz that is so interesting is that what they do is they match social media sentiment. So all of your favorite influencers sharing those companies that they think is valuable. And then they take the popularity of what's being said on social media, in the news, in blogs, and any other news sharing outlets. And they select those companies that they think are going to be high performers. Why is this important? Why is this important? Because right now, a lot of people are new investors. They're new to this space. And instead of doing research, sometimes they react based off emotion. What this particular ETF does is it takes the emotional reactions of people and puts them through an investor's framework so that when people invest in these ETFs, they only choose those companies that have strong balance sheets and also market capitalization, which means that they have strong balance sheets, good cash flow, and they're also just great companies. All right, so let's keep going. The thing that you want to look at is what is the expense ratio. All right, what is the expense ratio? What the expense ratio means is how much the portfolio managers are charging you in order to choose the best companies that come into that particular fund. All right, you want to look for an expense ratio that is below 1%. For Buzz, it's 0.75. One of the things that I also look at is what is the 52-week range. The 52-week range is what's the cheapest you could have bought this stock within a 1-year time frame, and what's the most expensive price that people have purchased it from, okay? Because Buzz is a new exchange traded fund, its lowest price was $22 and its highest price was $25. So for those of you all looking to invest in a new exchange traded fund, and we're going to talk about some of the risk here too, this one is coming in at just $25. It also has 75 holdings. What do I mean when I say holdings? These are the companies whose stocks they hold in the funds. They have 75, and these are all large capitalized companies. So these are companies whose name you recognize, like Novavax, Amazon, Apple, DraftKings. So those of you all, you don't play the lotto, but you be up on the internet betting. Advanced Micro Devices, Boeing, Tesla is another one. Tesla has been extremely popular, but it's also been extremely volatile. Some people have purchased Tesla at $400. Other people purchased Tesla when it was $850, right? Instead of purchasing one share of Tesla, by investing in this fund, you own a small percentage of Tesla, but also a small percentage of the other 74 companies that are in that portfolio. Square is in there, Virgin Galactic, and also NVIDIA. And these are all names of companies that have strong balance sheets, but also that have made headlines recently and for which people are talking about on social media. So you see, I didn't say GameStop. GameStop is super controversial because GameStop is a company that is located in a mall. A lot of malls shut down for months, and they ask for people to sell their games for cheap, and they resell them at a higher retail price. Well, now a lot of people are doing online gaming, right? So for those people who are investing in GameStop because it was trendy, but not necessarily because you thought it was a good company, you might have lost money. And so where Buzz comes in is they do that research for you, and they make sure only good companies with strong balance sheets are included. Now, one of the things that they use before they select companies, you have to be listed on a major U.S. stock exchange, all right? So that means the New York Stock Exchange, the NASDAQ. If you are not coming up there and you rolling with the big boys, you can't be in this fund, right? You already know how that is. It's like you got to get your weight up, right? One of the things that Lynn Richardson says all the time, I love her. She's a financial advisor. She's like, if you got 9 broke friends, you're going to be number 10. If you got 9 wealthy friends, you're going to be number 10, right? But in order for you to check the circle that you surround yourself with, you got to check the credentials. It's not what you say on social media, it's how you live your life, right? It's how you live your life. Are you balling out of control, but you on hourly pay and your savings account on negative, right? So for them, they check your receipts, right? Are you on a major stock exchange, because that requires rigorous review. Secondly, you have a minimum of a $5 billion market cap. So that means you got to be making money, honey. You got to be making money. It can't be lip service. It got to be cash in hand. It's got to be MIP, money in pocket. And finally, you have to have a 3-month minimum average trading value of at least $1 million. And the reason why I like this is because we can criticize those people who respond to social media all the time, but that's not helpful, right? People who have made sometimes, I would like to say uninformed investors' decisions, I applaud them for at least getting started, right? There are some people right now who are afraid to start where they are, do what they can, and use what they have. So for those people who had the courage enough to make their first investment, whether it was uninformed or not, at least you have a brokerage account and at least you have a funded account. Buzz takes the guesswork out of it, right? So if you see something trending across the social medias, right, trending across the internet, go to Buzz, look at their holdings, and see if they pass the muster. So let's keep going. Y'all ready? Y'all learning something? Give me a heart if you learning something, y'all. I'm feeling good. Let me throw a braid for you. Whenever I throw a braid, that means I'm happy. Come on, let me bring it back so I can throw it again. Woo! She happy. Hold on. Let me just throw 2 braids because I'm happy. Okay. So let's talk about Ark. Let me tell y'all, I love me some Kathy Wood, all right? So Ark, that is A-R-K-K. That is a woman in the investor space who has gained popularity for being a Warren Buffett beating boss babe. Why do they call her a Warren Buffett beating boss babe? Because her projections and predictions for exchange traded funds have totally superseded and exceeded the expectations of one of the most well-known investors. That's no shade on Warren Buffett, but the exchange traded funds that she managed last year returned sometimes 100+%. That means that if you invested in one of her funds, you may have received 50, 60, 70%, 100% returns. Why? Because Miss Kathy is betting on disruptive innovation. And what happened this past year, right, when we all went home? A lot of smaller companies had an opportunity to provide for the needs that larger companies could not. Peloton, right? Peloton kicked Planet Fitness behind because nobody wanted to be up on the treadmill breathing all up in your face. Breathing all up in your face. You don't know what they got coming up out their mouth, but Peloton allowed you to be safe in your home with your hungry kids, right? She bet on those companies, right? Like Teladoc, where people could visit their homes inside of their homes, or visit their doctors inside of their homes. And so what was great about her is that her funds are forward thinking. And the reason why I bring this up is because the types of technology she's looking at is automation, right? So she's thinking about when you go to the grocery store, you have some people checking you out and you have machines where you check yourself out. She's thinking about big data, right? So when you taking pictures for the gram, you got your boyfriend or your boo all up on the ground, right? The head all up on the ground taking pictures for you because you got to get the best angle, right? Those pictures got to be still stored somewhere. She's thinking about next generation internet like machine learning. She's thinking about financial tech. She's thinking about how autonomous driving vehicles. She's thinking about clean energy. She's thinking about how will the world look 20 and 25 years from now. Okay? And I think that that's a great fund to consider, especially as a new investor, because we're looking for ways in which your money can grow potentially faster. There are still no guarantees with investing. Now, the expense ratio for this is 0.75%. And again, remember I said your expense ratio should be less than 1%. The 52-week range for Ark within a 1-year period was as low as $39 and traded, which means that you can sell it or buy it, as high as $159. Imagine if you had invested when it was just $40 and it's $150. That's a huge return, right? And these are the types of returns that she realized last year. Now, within her fund, she holds between 30 and 55 holdings. Remember, holdings, right? Holdings is the companies whose stock she holds within the fund. And top 10 holdings in the ARKK, the Ark fund, include Tesla. So yes, someone said in the comment section, she expects for Tesla to hit $3,000 by 2025. And last Friday, it was trading at $642. I don't know what it was trading today. I haven't taken a look. But Tesla, Teladoc, Square, Roku, Zillow, any of you all shopping for homes, if you're using Zillow in order to see what type of homes are in your area or how you can compare one home to another home. You use Zillow, Shopify. So a lot of entrepreneurs open storefronts on Shopify when they had to close down their real storefronts. And a lot of new entrepreneurs who are starting online businesses use Shopify. And finally, Zoom. It's some of y'all right now, y'all worried about Zoom sending y'all a rent bill. Y'all spend so much time on there, laid all up on Zoom. You know, all up here, you looking great. Down below, looking crazy. You looking crazy. You swear, you wearing sweatpants, you're ashy, and your toes ain't been done in 10 months. 10 months. Toenails scraping across the floor. But as long as you got your face beat, you got your edges slick, right? You got your little collar all popped for Zoom, you know, you feel like you can live all up on there. You know, but there's some people on there, I need you to get your toenail clippers because your neighbors downstairs can hear you walking across the floor. It's not cute. It's not cute. So I can't wait for full body Zoom so people can get that together. But Zoom is one of the top 10 holdings in the Ark fund. So here's the thing about the investment methodology of Ark. They do say that one of the risks of investing in Ark is that these are new and disruptive innovations, right? So these are companies like Peloton who did great in 2020, but as gyms begin to open up, where will that leave Peloton, right? So yeah, we're talking about big data and how people kind of store things online, but what happens, right? If you can take a picture and there's a different way that you can store it. Maybe people want to start using Polaroid cameras and you want to do this. You know, y'all, who remembers a Polaroid? You take a picture, you got the little picture, you got to wave it like this. It's black, you're waving it. You got to blow on it until you can see yourself. Maybe Polaroids are making a comeback. I don't know. With disruptive innovations, there's a potential that these businesses could go out of business. But for her, she's thinking always towards the future. So Tesla, again, representing electric vehicles, right? And a projection that in 20 to 25 years, the gas guzzler that you have right now will be obsolete. So that's the ARKK fund. If you had invested $1,000 in the Ark fund, in the ARKK fund ETF, you would have made $2,520 last year. Hold on, where's my brain? Boop, gotta throw that. If you would have invested $1,000 at the beginning of last year in the Ark fund, your returns would have been $2,520. That is your money going to work for you. Now, y'all already know how I talk about how money can't live up in my house and not go to work. You work in one way or the other, and it's not underneath the mattress, honey. You going to work in the savings account, giving me a 2-3% return. You going to work up in the Ark fund, giving me 60, 70%, 100% returns. You going to work in the SPY fund, giving me 40% returns. You going to work. You going to work in my small business, and you giving me back some cash flow, honey. But money can't live up in my house rent free, and you need to have the same attitude. If you put your money to work, $1,000 in the Ark fund last year, your money would have came back $1,520 in your hand at the end of the year. While you was on Zoom with your crunchy toes. So let's keep going. So that's the Ark fund. So let's keep going. Next, we're going to talk about mutual funds. Mutual funds, right? You know, you hear this on the news and they always make it seem so boring. Oh, we're going to talk about mutual funds. You be like, hold on. Where's Real Housewives of Clark County? You know, where's Real Housewives of Southeast? Where's Real Housewives of Detroit, right? Where's Real Housewives of Cleveland? I'm sure they don't have no, I don't watch Real Housewives. They go everywhere. They go everywhere, right? I don't know if they over there in those cities. But anyway, while you over there watching Real Housewives and people talk about mutual funds and it sounds boring, mutual funds can be really fun. And the reason why I think it can be really fun because it can make you a lot of money. So let's talk about retirement, why it's important for you to know about it and why it's important for you to know about it for your child. Yes. You got a baby, the baby 5 months. We need to be thinking about when a baby girl gonna retire. We need to think about when baby boy, when he gonna be up in his house, right? Old and retired, right? So the average black family's retirement is $29,200. I'm gonna say that one more time. The average black family only has $29,200 saved up for retirement. There is a professional watching this right now that if Karen invited you into her office and she said that your new salary was going to be $29,200 for the next 5 years, you would take your hair, put it in a ponytail so quick, you would grab that Vaseline, slick it across them knuckles real quick, and you'd be like, Karen, what? Listen, Karen, I know we've been working together 15 years, but you ain't gonna have me walking up in here 2 times as hard, talk about some 29 too. You Karen. You about to fight Karen. You is Karen and Karen is you. That's what happens when you're not serious about your retirement. You telling yourself that you are not worth being paid more than $29,200 a year. Mutual funds is what exists usually within your IRAs, your individual retirement accounts, your 401ks, and your 403bs, and your TSPs. The biggest mistake that I ever made with saving for retirement was allowing my job to choose my mutual funds for me. When you allow your job to choose your mutual funds for you, they will choose the most conservative investment that they can possibly choose. Because they're not looking out for you. They ain't looking out for you. They're like, okay, she wants a retirement fund. Throw her in some bonds. So what we're going to talk about is how you can make sure that you're choosing the type of mutual funds that maximizes on your retirement so that you and Karen don't have to, y'all don't got to get to the windmill. You ain't trying to work at Walmart giving out stickers. No shade. You trying to be retiring down in Johannesburg, living your best life. There's the braid flip again. So one of the things that you want to consider is mutual funds allows for you to benefit from compound interest over time. All right. The great thing about retirement funds is it disincentivizes you making early withdrawals. Okay. So that means that you can't say you want to YOLO over in Cape Town. Right? I think I just missed South Africa. That's why I keep saying you want to YOLO over in Cape Town and you're looking at your retirement account and you see 40K and that's the cost of a first class ticket, a villa, and whoever Stella was dating to help her get her groove back as your butler. Right? So it disincentivizes early withdrawals and it allows for you to benefit of compound interest. So we're going to talk about one high-performing mutual fund that I want you to look into. Of course, one of the things that I'm going to do is I'm going to break down the different mechanics of analyzing a mutual fund so that as you look into your retirement, you're able to assess whether the mutual funds inside of your account are viable. So first, you want to look at the type of investments that are inside of that mutual fund. All right? So they can be a large cap, mid cap, small cap. Large cap just means large companies. Mid cap just means mid-sized companies. Small cap just means small companies, right? You want to ask yourself, do you want to go with the big boys who are going to grow slow? That's large. The mid-sized companies who will have a quicker pace, right? So it's like you're not on a walker. You still on 2 feet. You're not on a walker. But perhaps you got the cane, right? So you walking, it's a little faster. In small cap companies, they running fast. But when you run fast, you can either get to the finish line before the cane and the walker, or you can fall and scrape your knee and stay down. You know how people be like, get down and stay down? That can happen with the small cap companies, or they can finish the race faster. So you want to decide which ones you want to go with. Large cap companies are a little more less risky. So like nothing has no risk, but it's less risky because these are larger companies whose names you recognize, like the Amazons, the Googles, the Facebooks, the McDonald's, the Boeings, the Home Depots. These are the larger companies, again, with brand recognition. The Walmarts, the dollar stores, the Dollar Generals. These are the large companies. Next, you want to look at the expense ratio. Okay? So the expense ratio should be less than 1%. So one of the things that you want to write down, okay, because this is the fund that I'm analyzing, is CPOAX. And this is Morgan Stanley's Insight Fund. Okay, Morgan Stanley's Insight Fund, who has within the fund large capitalized companies, which we will talk about in a minute. I research all of my mutual funds on Financial Times, and that website is markets.ft.com. So that is markets.ft.com. All right. So let's keep going. So we want to look at what type of funds are in there. So for what type of companies are in there. This one has large companies. We want to look at the net expense ratio. It should be 1% or fewer. For this particular fund, it's 1.17. So it's just shy of about 0.17 higher than 1%. But I'm going to tell you why I like this fund in a second and why I'm willing to pay the additional 0.17. You need to look at if it's a minimum investment. Okay? So the minimum investment sometimes is $0. So you could pull up with a couple of dollars, right? You got $5, put a little something on it, right? Put a little something on it, right? If the share price is $5, which it probably won't be, but you can start by buying just one share. And then there are some mutual funds that require a minimum investment. For this one, the minimum investment is $1,000. And the reason why I chose that is because we're talking about stimulus checks. And for some of you all, your stimulus checks will be at least $1,400, right? Top 10 holdings. You want to look at what are the top 10 holdings and how are they performing, and are these companies that have strong balance sheets. So for them, that's Amazon, that's Square, Shopify, Uber, right? Some of y'all Uber Eats knows your name. They know your government name. In fact, they know your government name, but now they done giving you a nickname. Your name is Keisha. They know you as Kiki. They pulling up with your order right now, knocking your door, talking about Kiki, come get your food. Uber, Spotify, Snap, Snapchat, right? People been talking about Snap recently because I think it was like an internet influencer that was a little unfaithful and he used Snap because Snap got them disappearing messages, right? So, but that's not why you use Snap though. You use it for social media. We talking about him, not you. All right. And then Twitter, right? We love Twitter, right? We on Twitter. You got little Twitter fingers. You done perfected just typing out all of your thoughts and just a little bit of characters, right? So Twitter, we love Twitter when we watching our shows, right? Because Twitter allows you to have a collective conversation. So these are the top 10 holdings in this particular fund. And again, that's CPOAX, all right? CPOAX. And that is Morgan Stanley's Insight Fund Class A, all right? Here's why I really like this fund. They focus on long-term capital appreciation, all right? So this is important for you to understand because, again, the language of wealth that financial analysts use, I try to make real for the people. Because I don't want you to hear long-term capital appreciation and think that because you don't understand the term that you can't benefit from the value. Somebody write that down. Let me throw another braid on that. It should not be because you don't understand the term that you can't benefit from the value. So long-term capital appreciation, it means that these fund managers are looking for those businesses that have the potential to grow. Where will Twitter be in 5 years versus McDonald's, right? So like where will Spotify be, right, in relation to the radio? When's the last time you listened to the radio versus the last time you bumped your favorite playlist? Same thing with Amazon, right? You already know, some of you all, you get your package in 3 days, you call it slow. Don't you remember when you had to wait 2 and 3 weeks for somebody to mail something for you? Now, if it don't come in 2 minutes, you mad. You upset. You ordered it at $5.25. You at your door at $5.26 talking about where is my package? Amazon has spoiled you. They have spoiled you, especially our Prime members. So they're looking for those companies that have the potential to continue growing rapidly, okay? So the reason why I like this fund and how you should evaluate mutual funds is you need to look at their 1 year, 3 year, and 5 year returns, okay? So last year, there were mutual funds that were returning 40, 50, 60, 70, sometimes even 150%. So that means people got back 100% of their investments last year. But last year was a unique year because we were quarantined and we were at home, and technology experienced a huge boom as all of us, well, most of us socially distanced and stayed away from people, right? So now that the economy is beginning to reopen, a lot of these mutual funds are not going to be able to repeat the same performance in 2021 as they did in 2020. And so you need to look at how the mutual fund was managed even outside of a black swan event. A black swan event means that you didn't expect it, right? It's like watching Maury Povich. Who is the daddy? I don't know. Eeny, meeny, miny, mo. It's an unexpected event. It could be Bob. It could be Ramon. You know, it could be a soul man. Hold on. Ramon. You know, It could be Nut. You know, it could be Hustle Man. It could be Devo. It could be anybody, right? An unexpected event. Black Swan. So like for this particular mutual fund, 10 years ago, it returned 24%. I dare you to find a savings account that has a 24%, will pay you 24% in interest because you decided to save your coins. Still save, right? Saving is important. But the great thing about mutual funds in retirement, returning at 24%, wow, right? Some of you all see a 10% sale on on an outfit that you want, and listen, you got your purse, you got your little purse on your arm, you know, you gone, buy a 10% off sale. Imagine they were paying you 10%. Imagine they were paying you 24%. 10-year returns, 24%. 5-year returns, 42%. 3-year returns, 47%. 1-year return, y'all, 122%. If you had your money in this particular mutual fund last year, your returns would have been 122%. And this is revolutionary because Black people generally start saving for retirement when they're about to retire. That's why I said that every single parent needs to go look at their retirement and begin to analyze their mutual funds, and every single parent needs to start a retirement account for their child. So their child doesn't have to be worried about what they're going to be doing at 50, 55, 60, and 65, right? That they already have a nest egg because their parents had the foresight to begin investing on their behalf. This particular mutual fund returned 122%. Had you invested $5,000, if you invested $10,000 in this fund 10 years ago, your $10,000 would be worth $86,000. That's $76,000. That was hard working money. We already said money got to go to work. Money can't live in your house rent free. Not up in here. That was some hard working money. That money went out at 9 a.m., came back at midnight, passed out on the ground, and you left them there. You said, get your rest because you're going to work tomorrow. You got work 7 days a week, 25 hours a day. So like $86,000 in 10 years. One of the things that I look for a mutual fund is I look at what are their metrics of success, and that's called the benchmark. Their benchmark of success, which is the Russell 3000 growth, that means they said if my fund can make at least this much money, we would have done all right. Their benchmark said they had to at least return of $45,000 with a $10,000 investment, and they would have did good. You invested $10,000, you got $86,000. I think that's excellent and that's great. If you would have just had your money in that fund for 5 years, your $10,000 would have came back with $21,000. That's the cane. They ain't running hard and scratching knees or nothing, but they're going out, they're going to work, they get honest living, they doing the 9 to 5, taking off on the weekends. But $21,000 isn't bad for your money to go to work. $10,000 come back with $21,000. You know, when I think about my money going to work, I be thinking, hey, baby, I got your money, don't you worry. I said, hey, right? That's what I think about with my money. And they come in the door, I be like, hey, you got my money, just like ODB. Hey, money, you got my money. So you got to think about that. That's how I think about my money. I be looking at it. You know, you be looking at somebody across the room, but they can read your face. I be like, hold on, wait a minute. You already know what I'm thinking. You've been sitting down too long. You have to be to work at 9 o'clock, but it's 8:58. How you gonna get there? Because you ain't no sick days over here, money. We ain't got no sick days. We ain't got no vacation days. No days off. So let's keep going. So let's repeat. We talked about VOO. We talked about SPY. We talked about ARKK. We talked about Buzz. We talked about CPOAX. And if you have been in this live on WP time, Wealthy Time, you have already learned how to level up your investment all the way up to 122% returns. Let me say that one more time. If you have been in this live on WP time, which is Wealthy People's Time, you have already learned how to get returns on your investment up to 122%. So when I say things, right, like SPY, like VOO, like Buzz, like ARKK, like CPOAX, I am speaking to you the language of wealth, and now you understand it. Let's keep going. So next, what type of business can you start with $1,000? Now, I want to say this. Not every person needs to start an LLC, but perhaps those business-minded people who are looking for an additional stream of cash flow need to be a sole proprietor. I know LLC will get you 15 likes instead of 5, but an LLC is for those people who have proof of concept. There are some of you all who could be business owners as sole proprietors and independent contractors and benefit from the tax code without having to worry about, is your business idea good enough to get other people to pay you for it? One of the things that I like to tell people is the home-based business that you want to start is on the other side of MLM. Now, I know when people think MLM, right, they think about Ponzi schemes. And it is true that people who have MLM aren't entrepreneurs, they're salespeople. But what they also are independent contractors. And what that means is that as independent contractors, they can benefit from tax write-offs. That means that you can start with Amway. Y'all remember the Amway girl? You can start with Mary Kay. You can start with Herbalife. You can start with Flat Tummy Tea. Find yourself a black MLM, a black-owned MLM. You can start for less than $100 and write off $5,000 in expenses this tax year. You didn't have to worry about whether you're going to sell red lipstick or purple lipstick. You didn't have to worry about getting up in your kitchen and putting the oil in. You got tea tree oil. You got Jamaican castor oil. You try not to burn down your kitchen. The fries flying over here in Crisco. You mixing Jamaican castor oil over here because your edge is falling out because you're trying to start a business. Somebody has already thought of the business idea. My first recommendation to people who say all I need is a 9 to 5. Having one stream of income is hazardous to your wealth. I had to place another braid over here. Having one stream of income is hazardous to your wealth. Inside the braid, put it over here. That's a flip. Every black person needs to become a business owner, even if you never wanted to be an entrepreneur. There are people who own businesses right now. They spend $50 to $150 right now owning and operating a home-based business like Amazon, write off $10,000 in expenses. The tax code is their cash flow. That's the unpopular thing that people don't want to tell you. They want to talk to you about registering for LLC fees. They want to talk to you about registering your business. And there's a time and there's a place for that. Because I have 3 LLCs and I have a 501c3. But for some of you all who do not want the stress of coming up with a creative business idea, there is a $15 MLM that you can get into right now. And the cell phone that you're watching me on, the internet bill that keeps you connected to Cricket, the laptop that you use to get on Bumble today to find yourself a date on Saturday, as long as you periodically use that to attempt to make a sale, those are now tax write-offs. And the one word that people miss in my videos and in my captions is the attempt to make a sale. Black people are overachievers. I'll just say it. Any people who can survive slavery, dominate despite discrimination, and excel even despite, and still emerge all parts black boy joy and black girl magic is a resilient people. Black people are overachievers. You cannot tell me that we are a lazy people. Why am I going in so hard? Because some of you all were taught that you had to start a business that made a substantial amount of money because that is the only way that you could accumulate cash flow and multiple streams of income in your life. Now, these are people who just had a president with a 3-digit tax bill. A billionaire. You paid more taxes than him. Income is taxed at a higher tax rate than wealth. Some of you all missed that. Assets, the investments that we just talked about, the exchange traded funds, the mutual funds, they are taxed at a lower tax rate than the separate but unequal income that you earn at a job. And this is why I say, do the MLM. Someone clowning you because that you selling Amway. They clowning you because you got your brochure with some blush in it. They clowning you because you got Herbalife and you trying to sell them some flat tummy tea. You know they need some daggone flat tummy tea. They know it too. Even if they say no, The tax code allows you to write off thousands of dollars a year for 3 to 5 years legally. That means if you earn $50,000 and you subtract $5,000 from that, now you only owe taxes on $45,000. How many sales did you make? 0. But people are overachievers. We think we have to make money in order to get cash flow. And for the most part, that's true. But in some instances like this, the tax code was set up for owners to win and employees to pay. The game is in the attempt, not always in the delivery. And that's why I talked about how $1,000, the first business you should start is one that someone already started. They did all the work for you. They send you a brochure. They send you some products if you happen to sell it. You don't have to think about, should you put a girl in a pink suit, put a boy in a black suit. You don't have to think about it, should your color be green or should your color be beige. You ain't got to think about what ingredients go in the daggone joint. You don't got to even think if it tastes good, look good. All you got to do is say, sign me up. There is somebody right now that wish you came over their house and ate their dry celery and drank their tap water so that they can sign you up on their team. No shade. I don't like dry celery, but I'll eat it. It's an opportunity for you to benefit. And this is what I want you to help yourself understand. How to use the tax code. Let's make it plain. Let's make it plain. How to pimp the tax code for every single dollar that it steals from you by April 15th on a normal tax year, May 19th this year. Uncle Sam always has his hand in his pocket. You don't think your Uncle Sam has his hand in your pocket? Go try to buy something and not pay taxes. Oh, it's going to be a state tax. It's going to be a federal tax. You think Uncle Sam doesn't have his hand in your pocket? If you get direct deposit, ask yourself, in your offer letter, how much money they said they were going to pay you, if that's how much lands in your bank account every other week or on the 30th day of the month or the 1st of the month. The free game is in the attempt. Now, the last thing I'm going to talk about, give me a heart if y'all got something from that. Because let me tell you, y'all, when I start talking about the tax code, your girl just start glistening. It just start glistening. The last thing I want to talk about, and maybe I might save this for the next live. And that's Amazon fulfillment. I'm going to save that for the next live. How I want to close out on this live is, I want to encourage every single person watching this to never be intimidated by terms that you don't understand. Your ancestors worked so incredibly hard to build a capitalist economy for which white privileged men benefited from the brilliance of black people. When I think about the tax code, when I think about the stimulus, not the check, but the bill, I think about every single dollar that this government owes to my ancestors and that the government owes me. And I say to myself, they need to run me my check. That it is continuously past due. And that's why having multiple streams of income is a necessity. And that's why we're not flexing with liabilities anymore. That's why we're learning the language of wealth, so that people don't try to confuse us with terms that they did not teach us in schools. This is why we're learning assets over liabilities, right? Shout out to Earn Your Leisure. This is why we're learning that saving, though unsexy, is actually the sexiest thing that we can do. Because if we have a friendship circle, or we have someone that we're dating that thinks because we are pulling in our belt buckles right? That we are sacrificing so they can reach our success, that we are uncool, and that is not the friendship circle for us, that is not the partner for us. Because when we hustle, it is never for our first name. When we hustle, it is never for a flex. When we hustle, it is always for our last name. When we hustle, it is always for our descendants. A people with no capital in a capitalist economy will remain economically weak. And this is why learning the language of wealth is so important, because our assets should live beyond us. But the lessons that we learn, even as we experience losses, is the language that we teach our children, and they teach their children, so that we don't have to go begging other people to do for us what we are capable of doing for ourselves. Black people are overachievers. And that's why I want to leave the live tonight. Thank you so much. And this live is going to be posted on my YouTube. So if you haven't subscribed, please do that. My baby, the Black Entrepreneur's book, just started being delivered this week. Thank you, everybody who's tagged me. I'm sharing you on my stories. And I will see you next Wednesday. I love you all.